I mean, this could be what triggers a massive kind of recession, if not worse, is that when they run out of money and the Fed has just hiked and hiked into it, there's going to be a cliff dive in the economy.
Is it possible the Fed could overshoot, in your view? Do you agree? It's 98%, another 75 basis points. Do you think they need to stick to that to handle what we're seeing, this hot inflation that we're seeing in around the world, really?
Despite the fact that founder of ARK Invest, Cathie Wood, was one of the first macroeconomists to declare that the U.S. was in a recession, she's been vocal of late that this is not a recession like others. It is what she calls an inventory recession. In today's video, she would disclose why she recently wrote an open letter to the Fed, calling for easing in place of the quantitative tightening that has meant the Fed increasing interest rates. Before you go on, it is important to subscribe and turn on the notification bell. These are crucial times you need to stay updated with the economy.
I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world, and especially in the United States. It looks like some of the best supply chain managed companies in the world have over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling.
Gold, which used to be a good indicator of inflation, has not performed as expected this year, despite the commodities price hike that came at the end of Q2 of this year. Cathie Wood has maintained that this recession is an inventory recession. If we're to judge by gold price, she could be right that this is not a deep-seated inflation. It is one that was enabled by the lockdowns and recent war in Ukraine. There are only 2 Federal Open Market Committee (FOMC) meetings left this year, and the possibility of a rate hike is extremely high. We could be seeing another 75 basis point increase. It is projected that interest rates could reach 4.75%. Nike is also fighting an inventory crisis. The company has overstocked beyond their rate of sales. This has negatively impacted its sales. Coming out of the COVID-19 market shortages, most businesses had overstocked, expecting that sales would be aggressive the moment the COVID-19 slowdown was over. Unfortunately for them, the markets have not had the huge demand surge they anticipated.
So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker do? In the early 80s, he took interest rates from 10 to 20%. That's a 2-fold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories.
The president of the Chicago Federal Reserve, Charles Evans, seems to be giving us a clue that the authorities are paying attention to not overshooting and bringing inflation down. If the interest rates are too steep, we could be dragged down to a recession in what is called a hard landing. What the Fed wants is a soft landing, where inflation is brought under control without a sharp rise in unemployment and without severe detriment to the economy as a whole. He suggests that the Fed needs to pause and watch how the economy reacts to the QT measures already put in place. The interest rates have risen very sharply, one of the steepest in the U.S. history, starting from near zero in March and expected to reach 3.25% by the end of the year. Though, as earlier said in this video, projections are now as high as 4.5% for this year, as inflation rates have not dropped as fast as the Fed had expected. On the other hand, unemployment remains extremely low despite months of rate hikes. Charles Evans believes it is possible to bring inflation under control and keep unemployment low. It should be remembered that the Fed had expected unemployment to increase. Instead, it has dropped to 3.5%. In the midst of the whole economic turmoil, things seem to be looking up for the economy. For one, imports have gone down, thereby boosting the U.S. balance of trade. Imports had fallen by 1.2% in September, and this has had an impact on commodity prices, which also has dropped 0.8% across the board. In this past third quarter, the U.S. Imports Price Index has fallen by 3.7%, the highest since May 2020.
We are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang, and that it's going to be a serious inventory correction, but it's not going to be anything like we saw in 08, 09. That was a systemic financial problem caused by the mortgage and financial meltdown. We don't think this is the same thing. So now that many economists are starting to agree with us that we're in a recession or going into a recession, we feel that they might become a little bit too alarmist if this is just an inventory recession. And I think the Fed will have a lot to do with whether or not it is. This is a shock, though, to the system. And this idea that we have an inventory overhang, we think it's going to get bigger as consumers pull back, low saving rates, 3.5% versus 8% where it was before COVID. And so we'll see. We think this holiday season is going to be pretty tough.
Cathie says we should not expect a long, bitter recession. She says this is just an inventory correction. Do you agree? Please like this video and subscribe. It's much appreciated. Watch out for the next video. You don't want to miss it.